Hello, everyone. I want to talk about an important concept that you need to be aware of if you are an options trader. And I've seen a lot of options traders lose money when they're getting started out because they don't understand this concept of what we call time value decay. There's a fancy term for it too called theta. There are these different Greek letters that are used to describe different aspects of options. But if you're starting off, I think the only one you really need to really care about is this concept of time value decay. So let me just kind of get right into this here. First, we need to understand what are calls. We need to understand what are calls and what are puts. All right. So a call and a put are it's a contract. It's an option contract, hence the name option contracts. A call gives you the right to buy a specific security at a specific price up until the expiration date. Now, when you buy a stock or sell a stock or buy an option or sell an option or a crypto or whatever it is, you have to understand there's someone else on the other side of the trade. If you go and you buy a call, you're not just buying it from out of the nebulous ethernet. There's someone who sold it to you. Now, a call gives you the right to buy I'm going to just say stock, but it could be on cryptos or bonds or futures. But a call gives you the right to buy a specific stock at a specific price, which is called the strike price, up until the expiration date. That's the day the contract expires. A put gives you the right to sell a specific security at a specific price up until the expiration date. So whoever you buy the call from is guaranteeing you that they will sell you the stock at that price regardless of where it's trading in the market. Whoever you buy the put from guarantees that they will buy the security from you at that price regardless of where the stock is trading in the market. So we have the expiration date is the day the contract expires. The strike price is the price that the contract establishes that the trade can be made, or the trade can be made at. Now let's talk about a call and this concept of intrinsic value. Okay, if a security is trading at a higher price than the strike price of the call is said to have intrinsic value. Think about it. If you have the right to buy something at 20 and it's trading at 25, well, that right for you to buy it at 20 is going to be worth at least 5 points. You have a contract that guarantees you the ability to buy the stock below where it's actually trading at. Now, if you have a call that has a strike price of 20 and the security is trading at 15, well, your contract isn't going to be worth much because who cares about the right to buy it at 20 if you could just go into the market and buy it at 15? Now, as you can imagine, puts are the exact opposite. Whoever you buy the put from guarantees you that that the put gives you the right to sell. Whoever you buy that put from is guaranteeing you that they will purchase whatever security it is at a specific price up until the expiration date. So if the security is at a higher price than the strike price of the option or the put option, there's no intrinsic value because say the security is trading at 25 and you have a contract that gives the right for you to sell it at 20. Well, who cares? People could just go sell it on the market at 25. So who's going to buy a contract that gives you them the right to sell it at 20? So if a put has a strike price of 20 and the underlying security is 15, there's 5 points of intrinsic value. It's trading in the market at 15, but you have the right to sell it at 20. Now, if the security is at 25, well, your contract isn't going to have any intrinsic value because there's really no value in being able to sell something at 20 if it's trading in the market at 25. Now, here's where it gets interesting. And this is what we need to pay attention to. Okay. It's once again, an option is a contract. Now, as with most contracts and whatever it is, the farther out the contract goes, or the longer the time the contract is in effect, the more it's going to cost because you're going to have a greater odds that things go your way. So if you lock in a contract that expires in a week, that's going to cost you less money than if you have a contract that expires in 6 months. say all else is being equal. In other words, a call contract that expires in a week for with the strike price of 20 is going to cost less than the contract that expires in 6 months, because in 6 months there's greater odds that the stock or that the contract gets an intrinsic value. If it's okay, it's the same thing with puts. The longer out you lock in the contract for, the more it's going to cost you. That's called the time value. All right. Now this is more important. This is important, but it's might sound complicated, but it's really not. It's just like anything. Any contract in whatever field it's in or whatever business it's in, the longer the expiration or the longer the contract is in effect, the more it's going to cost you to enter into it. Now, this is the important part. As we get closer and closer to the expiration date, the time value will decrease. Makes sense, right? Something is out 6 months, say your time value is X. As we get closer and closer to that expiration date, and now we're, say, 3 months away, well, the time value of X is going to be less because the contract is going to be shorter. So, because it's a shorter contract, or shorter term contract, I should say, it's not going to cost you as much money. Now, here's the thing, if the time value at the time of purchase exceeds the intrinsic value at the time of expiration, you could end up losing money. Say you think a stock is going to go up and it's at $20 and you buy the $20 call and it goes out 6 months and it costs you 5 points or $500. You're paying for that time of 6 months for things to go your way. All right. Now, as we get closer and closer and closer to the expiration date, that time value is going to decrease. Let's just say we get to the expiration date and the stock is at 22 and your call strike price is at 20. You have 2 points of intrinsic value. All right. But guess what? You had to spend 5 points on the time value. So even though we were right about the direction of the security, you thought it was going to go up and it did, you're going to lose money because the amount you paid for the time value is greater than what the intrinsic value is. So you have 2 points of intrinsic value, but the time value at the time of purchase was 5, so you actually lost money on this contract. You're going to lose $300. And the opposite is true with puts, okay? If you think something is going to go down and it's trading at 20 and you buy a put contract that gives you the right to sell it at 20, it goes out 6 months and it costs you 5 points, you've spent $500 in time value, or 5 points of time value. A point in an option is $100. So now let's just say you're right. And when we get to the expiration date, the stock is trading at 18 and you have the right to sell it at 20. You have 2 points of intrinsic value, but it cost you 5 points of time value to enter the trade. So you would end up losing money on this contract. So this is just an important thing to understand. The longer out the contract goes, the higher the amount of time value. As we approach the expiration date and the time of the contract decreases or diminishes, that time value is going to come down. Now, if you're a short-term trader, meaning if you are maybe a day trader or someone who only wants to hold on to a position for a couple days, you're in general better off buying nearer term contracts because there's going to be less time value. I mean, there's no set rule that's set in stone, and everyone has to develop their own style and have a style that fits your personality. But this is something to remember. So let me just sum it up here saying that you could potentially be right on the direction of whatever stock you're looking at, whether you think it's going to go up or go down. But if the amount that you had to pay for the time value exceeds the intrinsic value when we get to the expiration date, you are going to lose money even though you were right. All right, so thank you for being a member of Stock Market Jobber. We do a lot of work on options here. Most of our members of our community are actually options traders. So I hope this helps, and I hope to see you soon. Thank you, everybody.